And along the same theme of the making the decision, what are the top 3 to 5 factors that go into calculating a loan's risk?
That's a great question, and especially in these times. But really, it has not changed from what it was. I just think there's more scrutiny and measurement on it than there ever has been. And in my opinion, it's, again, the basics. It's cash flow coverage. Brad mentioned it already. And you know, again, I mentioned the collateral lending days. In my opinion, they're pretty much gone. We've got to have a source of repayment. You know, a lot of the collateral factoring, things of that sort, is specialized lending, and it is still very active, but equity is critical. You know, the banks, if you think about it, our end result and our best case scenario of any loan is the same, and that's just we hope to get repaid. And if we don't, you know, we're not sharing in, as companies improve, we don't share in profits or anything of that sort. So you know, we are asking for borrowers to have more skin in the game now. And again, that number has has not changed. Just several years ago, we just got relaxed on it. So we're really coming back to the way it was, you know, early 2000s and previously. Liquidity is something I mentioned earlier. You know, again, we look at that on several factors. Brad mentioned that some of the contingent liabilities, the other businesses you may be in. Well, what happens if those businesses decline? Is there enough liquidity to sustain those businesses and repay us, repay our loans? So, you know, of course, in cyclical economic downturns, it's a very important factor as well. Personal guarantees, I think for the smaller banks and even the larger banks, it's not something that they've steered away from greatly, but you might not see the limited guarantees that you used to see. So personal guarantees in this environment could easily be a deal killer in many instances. So lastly, I'll just say experience. Basically, you know, that goes without saying I remember I hear stories of developers who said, yeah, I need to find a new plumber because he just started his own business and you know, he's been on the job for a year. So again, experience is critical to calculating loans risk as well. So
I think Mark's done a very good job. He's pretty much hit all the points on that. Just a few more. The viability of the project. That's something in the past we probably didn't spend as much time on. We were rolling, everything was great, we were pumping loans out, and to really sit down and think, you know, hey, is this business headed in the right direction? You know, if they invest in this type of technology, are they going to be here for the long haul? Because, you know, once you go in and partner up with a business or an individual, you know, we're there to see it to the end. And I think that banks now are putting a little more thought into, does that project really make sense? As an example, on the development side, if you're in a neighborhood where homes are selling for $200,000 and someone comes in with something close by that wants to do $500,000 homes, instead of just saying, you know, that guy knows what he's doing, he's a developer, we are really having to spend a little bit more time understanding, will that really work? The other parts he's hit on, the liquidity, the sources of repayment, the strength. We all, that's what we look for.
There have been a lot of questions on our boards about what the impact is when a bank is taken over by the FDIC and subsequently purchased by another bank. The FDIC, in many cases, now insures the loans issued by the original bank. If the acquiring bank changes the loan's terms, the bank loses the FDIC insurance. So can you help us better understand this issue and the impact on the debtor?
The, the FDIC and the acquiring bank have different setups. I think each deal is a little different, and I can only speak on how our particular deal is transpiring. At the present time, the way that we are handling this situation, we can work with clients, we can change terms, but we can't do something that negatively impacts the loan. An example would be if we have a loan that has 3 guarantors and we look at releasing a guarantor. Well, we better have a good reason for releasing the guarantor. Are we taking some additional collateral? Are we doing something on the other end to improve our position so that it's a wash? If we go in and it's seen that we have lessened our loan terms, then that would apply. But as far as stretching out terms, trying to be creative, we're still there to try to work with people that can get through it. Even whatever it takes at this point. If we have to look at lowering rates, if it makes sense, we're here to try to analyze each individual situation, and we want to see them through. We certainly don't want to not do anything and just let it go away. I'm sure everybody's been talking about the loss share agreement. The way that we have been instructed to work that is that for the ones that cannot continue to make payments, that it goes down. It's the normal process, and once we then own it, we settle up, and then it's an 80-20 split. But it behooves us to work with as many people as we can, because that's what pays our bills. And we took over a franchise that has a long storied history, and they're in good locations. And if we don't try to do what we can to salvage as many as we can, I don't think we're doing a service to anyone. So that's kind of we're here to work with people within reason.